Welcome to the Creating Wealth Simplified podcast. My name is Lauren Wells, here with my co-host, Chris Seveney. We're committed to providing you with the knowledge required to build wealth through real estate investing. Tired of consuming content about real estate? Stuck in analysis paralysis? Ready to do your first deal? As a member of our community, you will learn how to go from consuming content to taking that first step into the world of real estate investing. Our show is not about getting rich quick, but about providing you with the knowledge you need to take action. Join us as we speak with experienced investors who share action tips on how to escape the corporate world, start a thriving side hustle in the world of real estate, and go beyond your W-2 or 401k.
Welcome back, everybody. Today, I have an episode that I've been wanting to record for a pretty good time now, and just really want to take the time to put what I wanted to say and get it out there. And I'm titling this one, Filthy Mistakes, Top 5 Pitfalls to Avoid when investing in a syndication, investing in a fund, or just investing in general. Because right now, we're starting to see cracks in different markets. We're starting to see changes in the overall economic environment. And people, I think, have short-term memory that the last several years were so good, especially in real estate investing. Now we're going to a time where it's not just based on appreciation, and even mismanagement hid those sins. Now it's going to focus really on the manager, their expertise, their experience. And I want to talk about that today. So I want to start with what I would say is, number 5, which is proper due diligence. And this is due diligence on the asset, on the sponsor. And right now I'm talking more about real estate investing, but this can, again, be done for anything, whether it's stocks or crypto, whatever the case may be. Just proper due diligence. And one of the first things that I see is lack of education from an investor. I see investors frequently will jump into a complex investment, whether it's mortgage notes, a multifamily deal, other types of syndication, self-storage, funds that do everything. They do a mix of different aspects of oil and gas and commercial real estate, crypto. Again, whatever it is, what I want people to understand is you need to have some knowledge on that asset class. And, knowledge today can be found online, can be found by talking to people, can be found in varying different arrays and methods. Some of the key attributes that you need to understand when you're getting that education is expected returns, the risks, the liquidity. Because, as we talk further on this episode, we'll see that there's investment options out there that when they're offering twice an expected return than the industry norm, that should set off little red flags in someone's head of how can they do this and not somebody else? And the answer is typically it's not a greedy sponsor just trying to keep it all, and we'll talk about that later. But a rule of thumb that I use as also a passive investor, and I think goes very well for people, is if you cannot explain the investment, then don't invest in it. That's what I go for. And that's why certain things like cryptocurrency, oil and gas, and other types of investment opportunities, I know people have made a lot of money in them, but I can't explain that investment and I don't understand it. So I will not invest in it. The other component that falls into the due diligence component is people who just listen to their friends without doing their own research. I see many investors follow recommendations from friends, colleagues, and they don't conduct their own due diligence. They're just, this person told me, And if people remember I can't think of the woman's name, but she created that device that could test your blood and supposedly tell you everything that's, wrong with you. There was a movie on it, and she was the one who dressed like Steve Jobs. I apologize. I just can't think of her name or the product that she had. But essentially, she was getting big time investors to support the company because it was just word of mouth. Oh, she has this person on her board. They have this person who said yes. Those examples where, there could be pyramid schemes and bad deals that people relied on others' advice. There's one right now where there is a sponsor out of, I think, Atlanta area who, again, we'll talk about that a little later, was promising these excessive returns, and it was basically getting investment people to raise money for them. And it was really kind of a pyramid scheme at the end of the day. So regarding due diligence, always research the sponsor, the market, the asset before making a financial decision, and talk to others about it too, who may have more knowledge in that space. Knowledge is power. So let's go to number 4. And this is diversification. Everybody's always told, don't put your eggs in one basket. Many of us work a W-2 and have a 401k. Is your 401k in something that is diverse, or you put everything in one stock or one type of asset class like tech stocks or real estate investment trusts? Where does that go? You're always taught diversify. And many investors sometimes focus too much on one asset class or a specific asset. And, there's so many alternatives out there, like real estate. We do mortgage notes, private equity. There's diversification not only from the stock market, because I believe in order to build true wealth, you should invest also outside of the stock market, but also within those specific asset classes. And diversification isn't just about, balancing stocks and bonds, but it's spreading that risk across different asset classes. But when you do that, there's the rule of thumb that avoid putting, 10% of your portfolio into any one single investment or asset. And what I see happen a lot is investors who are accredited, and, there's phrases out there, like we use acronyms like Henry, high earning, not rich yet. And I know a lot of people like this who make, 150, 200, 250 a year, and they may have 100,000 in the bank because they got money spread throughout and other things. Or maybe that's just, they live that lifestyle and they got 100 grand. They'll find a deal or a syndication or a fund that minimum investment's 50 or 100,000. They put everything there. And reading stories about this company that was out of Atlanta that, again, was promising 40% returns. I see online on Reddit and some of these other posts where people getting close to retirement put their entire retirement into this one investment. Please, people, do not put, your entire savings or investment, on one horse. Again, rule of thumb, no more than 10% of your portfolio should be in a single investment. And just because you're an accredited investor doesn't mean that you should go drop $50,000 in investment. That's all you have. We run a Regulation A+ offering that has a $5,000 minimum. There's plenty of funds like ours out there where you could spread that across 10 different opportunities, and deals do go bad. And people are now realizing that did not realize that 5 years ago. And it takes a lot longer if you lose, $20,000 in a deal and you had 50 to get to 30, to get back to 50, you're pushing a rock uphill. Remember that investing is a long-term play as part of that. So that diversification, I think, is so critical and important to understand that you, again, want to broaden your range. The other thing I'll just mention briefly is I know some people also who will diversify by investing in 3 or 4 different opportunities, but they're all the same. Like I'm going to invest in 3 multifamily deals in this one location, or I'm going to invest in only self-storage, or I'm only going to invest in these 3 different crypto. I would not spread everything across one asset class. It's like investing in just different airline stocks. That's not something that I would recommend. Now, I do have to say, give the caveat, I'm not a financial advisor. I'm not offering financial advice. Everything here is for educational content and purposes, and telling you what I see and kind of things that I do or would do with my portfolio. Let's go to number 3, understanding risk. So this one, I was curious where to put this one. Do I put it at 1, 2, 3? Where does this one fall? And when people need to understand risk, first is nothing is guaranteed, nothing is promised. Promises and guarantees do not belong in investing. Like going to a casino and playing blackjack and having the dealer tell you that you're guaranteed or promised that you're not going to lose X amount of dollars, or you're going to not lose anything. It does not happen. Now, investing is not gambling, but for some people, they invest, they gamble, it is. But please, please, please understand this. No matter what a salesperson, a sponsor, or anybody tells you, if they throw out the word guarantee, promise, that should raise huge red flags. Perfect example is there was this investor who was selling mortgage notes on land. And they were written at 0% down, 0% interest rate, and he was trying to sell them. He's been trying to sell them for like 5 years now, at like 50 or 60 cents on the dollar. And he was guaranteeing an 18% return to the investor. And what he was saying is, if this fails, I will buy it back. And I called this individual out on Facebook where it was. And he got extremely upset with me and told me I should stay out of his business. And I told him, if you're going to step foot in my Facebook group and start guaranteeing returns, I am going to put my foot down, because there's no such thing. Unless you put that money that person invested or that person paid you back into an escrow account that you cannot touch, and that money sits there and gets withdrawn as they receive their payments, if you're guaranteeing that return, that is the only way you could guarantee that. And he's like, well, I'm not going to do that. I'm like, exactly. He said, well, I'll buy it back. And I'm like, who's to say you're going to have the money? Do you know how many times I've heard somebody promise or guarantee something? We see people all the time online. I guarantee I'll pay you back if you give me a $50,000 loan, because I'm going to fix and flip this property and make $300,000. We see one of those posts every single day. Now, one thing to also understand is, sponsors, the people raising money for them, they can be persuasive, be very persuasive, and make it sound like it's not really risky. There's not a lot that could happen. I've been doing this for 5 years, or whatever the case may be. But always consider worst case scenario and assess the risk that's involved. And the other component with the risk is, the return. We have people who look at our fund and see that we provide, between 8 and 11%. That's not enough. I can get 18% on this multifamily deal. I'm like, you can, because they are 70% leveraged on that asset. They may have a variable rate, or whatever type of loan they have. It's a value add that they may have to increase rents, that they may have to renovate the property, which I spent 20 years in construction. Renovation is risky. Raising rents is risky. I was talking to somebody the other day about investing in these larger deals, and we used to use John Burns Real Estate, who would do market studies for us, and they'd cost $10,000 or $20,000. But they would take a look at that MSA and say, okay, you have 200 units. Here's the average rent for this type of unit, or if you upgrade it from a C to a B, here's the absorption rate. Here's what it looks like. Here's how many new product is coming on the market. Full-blown study, almost like a business plan of, would this or would this not work? And will you get the numbers that you think you're going to get? I've looked at many multifamily deals, especially the large ones. I've never seen anybody offer a market study. On a $50 million deal that they're raising money on, and they're getting $35 million loan, and no market study. Now you look at what's happening today in the space, and some people say that you couldn't see it coming, but I think common sense would tell you if the government was printing, I don't know, $5, $6, $7 trillion, you'd see a pop and then you spike, and then you look at any type of spike we have on anything, it comes back down. And that's what we're somewhat seeing now. Now, going back to my analysis of, okay, you could get 18% or lose everything. And this is, I'm not saying this about my fund, but I'm just saying this as, just something else. Any other offering that is between kind of 7 and 10% that doesn't have leverage, chances of losing everything, I think, are much, much lower. Now, would you rather target 7 to 10% per year or 18 or 0? I can't answer that question for you. That's a question you need to answer. And for some people, it's like anything. It's a balanced portfolio. If I have some high risk investments and I have some, other types of investments. It's an equity play versus an income play. Nothing wrong with it. I have investments that I consider higher risk, as part of my personal portfolio. But I understand it. What I typically see happen to a lot of people is they don't understand that risk, that they could lose it all. They didn't understand how high risk that was because they were guaranteed a promise, or they were told, oh yeah, we do this all the time. So when we talk about what we've gone through so far, proper due diligence, that's on you. Diversification, on you. Understanding risk, this is also on you, but it's stuff that there's an education component as part of each one of those. How to diversify, how to do proper due diligence, how to understand the risk. Number 2, FOMO, fear of missing out, takes no experience, none at all. And over the last several years, you saw it with GameStop, you saw it with, was it Dogecoin? I think you see a little bit now with NVIDIA. I'm using stocks as an example, but you saw it with short-term rentals. You saw it with self-storage. You saw it with multifamily. We've seen it in mortgage notes. Now, there's the changing trends or chasing trends that people get into, but many times by the time you're trying to get into it, you're doing it at the peak. And FOMO can cause investors to jump into an investment when it's due to fear, and they're going to miss out on that opportunity because, the good times may have already passed, but you don't know it yet. And you're also taking on considerable risk. I view it more as an emotional decision that can lead to buying investments at inflated prices or during bubbles. There's specific areas of the market that just popped, and people, so much FOMO that people have, short-term rentals, looking at, what's going on in Florida and Texas right now with pricing. Austin is an example, I believe, where, had such an influx, and now insurance, taxes, and other costs have increased. The demand isn't there. And now people are walking away from properties or, bought a property for 1.2 that's now worth $900,000. It happens. People just don't realize it because it hasn't happened in 10 plus years. For me, I try and stay away from FOMO. It's something that everybody gets sucked into. And, you have to kind of resist. And the way I look at things is, it's a better approach to invest with a long-term strategy, avoid emotional triggers, and stay focused on your investments rather than just chasing the trends, because there's always going to be a trend. Whatever happened to NFTs? Those come and gone pretty quickly, I would have to say, as an example. I know people who are, trying to create them or buying them, and now pretty worthless. When I was a kid, age myself, baseball cards. I'd always want to buy the new set, the new box, and I was a big baseball card collector. I still have a good collection. But everybody got into them. They started printing so many. And what happens? They get devalued. It's like anything. More of something there is and demand goes down, the less valuable it is. Don't follow the FOMO. Number one, I'd say, is an acronym that honestly kind of popped in my head the other night when I was like half asleep. I call it, being filthy. Falling in love, it leads to terrible high-risk yields. It's an emotional trap. Investors will fall in love with the sticker, somebody offers. 18%, 40% returns, 25% returns, historical IRR of 35%. When people promise these high returns, you really have to assess the risk that's involved. The SEC, Securities Exchange Commission, is littered with warnings about high risk yields, and understanding that it's not normal. Historical yields on the stock market and real estate are typically 7 to 10%. Yes, there's years it's higher. Yes, there's years it's lower. Yes, there's opportunities where you can make 20% or invest in NVIDIA or some of these other companies. But those are an equity play where you might get there. When I see income plays, like this one in Atlanta, which was offering 40% returns, when I heard that, I'm like, it's impossible. And name a company that historically can say, yep, we're going to give you 40% returns every year to investors and still have profit and do it where they could continue those returns. There's years companies, of course, make 40%, but consistently, if everyone else in the space is offering, 7, 10%, how does someone do 40? Even credit card companies, look at what they do. They charge, 18, 20% on unsecured loans, and they have overhead, and, they're not making 40% returns. There's another syndicator that was offering, 15 to 20% on notes. When again, average was about half that. People kind of put some caution to the wind on some of the forums. And I don't think people understood that full scope of the risks. To me, it reminds me of when I was younger and like you have your first crush on somebody. Basically it's like you're falling in love with them and like you just become star-studded in regards to how awesome it is without understanding the, some of the things that individual could also work on or some of their faults. We all have faults. Same thing as investments. You can't just be star-studded based off of, that aspect and fall in love. You need to understand everything. When you're relying on emotions and trusting these high promises, it can lead to terrible outcomes as a high majority of those deals often underperform or go completely belly up. So those are my top 5. As a little bonus, I was going to use one little more analogy that, a lot of this is based on human nature, which is honestly, it's greed. It's really what it boils down to. And when we look at it, anyone watching, you can see that just popped up next to me is I use greed as an acronym. It's getting returns eagerly and expecting big dollars. The G, getting high returns. Investors are seeking above industry standards on their investments. Be careful. Getting those high returns, yes, there's ways you can find companies that you believe have some type of advantage, but understand what that advantage is that they have. do not, whatever you do, fall for the rush into the deal, the R. You have to invest by this day. You have to do this. Now, we have in our offering, the end of every month, we notify people, hey, you invest by the end of the month, it starts accruing that following month. But it's not pressure, it's notification. The pressure is when you go to these high, intense sales pitches that, they tell you a lot of high level information and then basically have the people in the back of the room that are salespeople with the credit card machines that, hey, you can pay with your credit card today. That typically leads to more and more and more. Take your time, understand the deal. For example, with our fund, our Regulation A+ offering, the average investor journey is about 90 days. By the time we connect with them, we talk to them, we provide them education. We're not pushing them to say you got to, invest. We're educating them, and it takes approximately 90 days, which on average, it's going to be between 3 to 6 months people should do to evaluate these types of deals. The first E is excessive risk taking. I think we already talked about this, where you're pushing for the higher returns and you're taking on unnecessary or poorly calculated risk. You might not even understand the risk. Or goes back to, at FILLTHY, you're falling in love with that number that's thrown at you. And you're just like, oh my God, I can get this. And then realize my $100,000 is going to get me $40,000 per year. And then I can use that for college. I can use that. Well, what happens if your $100,000 went to zero? How does that impact you? Which the second E ties into that, which is expecting too much. If you have those unrealistic expectations based on hype or unproven projections, it can lead to challenges. And last is dismissing due diligence. Ignoring the key research, the risk assessment, because of your focus on those promised returns or the sales pitch you're getting from them that, yeah, this is what we do. We've got this many investors. We raised this much money. With that one that was offering 40%, right now they're under investigation for an alleged Ponzi scheme. And people who got in earlier were like, well, I was getting paid and I know this person and that person and this person, but at no point in time did anyone ever see any financials. I wonder if they ever asked for any financials. It's important as part of due diligence, say, hey, how do you report to investors? How do you provide financials? Are they audited? Are they not audited? Who does them? Where can I see them? Can I see them? Do I have access to them? If you're investing considerable money in a company, wouldn't you like the opportunity to be able to look at them or understand them a little better? At the end of the day, there's lots of information out there, and not every deal goes bad. Most of them actually probably end up going well. I wanted to share with you some of the top pitfalls to avoid when you're investing in a fund or a syndication. And for me, last words I'll leave with people is be patient. There's no such thing as a dumb question. If you don't understand the investment, continue to ask the question and have them explain it to you like it's a third grader or a fifth grader. It's okay. Nothing wrong with that. There's nothing to be embarrassed about. I was trying to understand a cryptocurrency investment, and I basically told them, explain this to me like I'm a second grader because I just don't understand it. Now, real estate, I can talk real estate, as you mostly all know, all day long. When it comes to things outside of my specialty, I don't study it. I don't put a lot of thought process into it. So I'm really not, understanding of it. So I want to thank you for listening to this episode. If you have questions, if you have comments, please feel free to reach out. Thank you all. Take care. Make sure to leave us a review on your favorite listening station. Thank you all. Thank you for joining Lauren and I on this episode of the Creating Wealth Simplified podcast. Each week, we bring you expert education, experience, and information in a digestible format to help you identify investment opportunities so you can build wealth through real estate and take action toward your financial goals. Enjoy the show, share with a friend, or subscribe to the show and leave us a review.